Well, let's talk real estate. The trend in home price growth continues. S&P CoreLogic Case-Shiller Index weakened yet again in March for the 12th month in a row, now showing an increase of 3.7%, and that's down from 3.9% growth in February. Joining us now is Danielle Hale, Chief Economist at Realtor.com. And Danielle, taking a look at the S&P Case-Shiller results today, the fact that we have seen home prices slow now for a year, I guess, down for the 12th month in a row. What do you make of those results, and how concerning is that for the overall strength of the housing sector?
I think when you're thinking about what these home prices mean, you want to consider not just where we are, but where we've been. So home prices we're up 3.7% today. That's still within the range of normal. It's just that we've been accustomed to home prices growing so much faster than normal because we've had such limited construction in this housing recovery that it feels like home prices are slowing, and they are slowing, but they're really just getting back to a normal range.
Do you think that the low mortgage rates could help mitigate some of the slowness that we are seeing within the market?
Yeah, absolutely. So mortgage rates have moved down pretty dramatically in the last few weeks, a couple months, as a result of a lot of this uncertainty over what's going to happen with the trade negotiations. And I expect them to continue to move a little bit lower as this uncertainty continues. That's definitely going to help buyers. In fact, with last week's data, we saw that home prices, or what people were paying for a mortgage, was about equal with last year. So lower mortgage rates are helping to offset the fact that home prices are still rising in many markets across the country. And so that's definitely making things more affordable and helping bring buyers to the housing market.
Danielle, I mean, some prices are still continuing to climb, but there's many markets out there, namely Seattle is one of those, that homes are just simply not selling as fast as they used to sell. That's been a trend that we have been seeing now for quite some time. So do you think that this is indicative of the fact that maybe some of these sellers need to start adjusting their prices? And do you think that we'll see this trend kind of spread out to the rest of the country as well?
Yeah, in fact, we are already seeing sellers adjust their prices. And you can see that if you look at our data on listing price growth versus sales price growth. Listing prices are growing faster than sales prices, and that's because people are pricing their homes pretty ambitiously when they come to list them to market, and then as they sit for a little while, they're adjusting their prices downward. That's why we see that gap at this point in the cycle. And I would say, you mentioned Seattle specifically, even though homes are selling there slower than they were a year ago, it's still one of the faster moving real estate markets in the country. So our days on market data suggests homes are on the market for just a month in Seattle, which is much faster than what's typical across the country.
Danielle, how long do you think this trend, or do you expect this trend that we're seeing in terms of slowing growth when it comes to home prices to continue within the U.S.?
So I think home prices will continue to slow back to this normal range. So our forecast for the year is for home prices to grow just below 2%. Just below 3%, so 2.9% year over year. So we expect them to slow on a monthly basis year over year down to around 2% by the end of the year, so that we'll hit that average target. That's on the low end of the normal range. 2 to 4% would be normal in the housing market, roughly on pace with wages. One thing I'll note is that at this point in the cycle, wages are picking up. So that's a good thing. And that should also, with low mortgage rates, help propel sales going forward.
Danielle, do you think that at all we are at risk to seeing a sharp downturn when it comes to the housing market, any sort of repeat as to what we saw just around 10 years ago?
No, so we've definitely seen sales slow. We've seen price growth slow. That's what we're talking about now. And so people are asking that question. But I don't think we're anywhere near a risk of repeating what happened 10 years ago. We just haven't seen the same levels of construction. In fact, 10 years ago, we were seeing record levels of construction. Now we're not even seeing normal levels of construction. And you just can't have that same extent of a boom if you don't have overbuilding. And we have underbuilding, not overbuilding this time around.
Danielle, I want you to stay with us. We also right now have Skylar Olson, Director of Economic Research at Zillow. And Skylar, we've been talking about the impact of housing, just what we've seen in terms of trend-wise for home prices across the U.S. The fact that we saw another month of slowing growth when it comes to home prices, why do you think, in terms of the reasons as to why we are seeing this, what's on the top of your list?
Yeah, I mean, top of my list is that, this is a price correction due to the fact that home values had grown over the past few years much, much, much faster than incomes, really kind of stretched the affordability bounds for a lot of current first-time home buyers and even for some cases repeat home buyers. And it's causing demand to have to pull back. The reason why we think it's more that demand is kind of pulling back and cooling off is because the new inventory that we're seeing, or the level of inventory that we're seeing rise, it's more that homes are left over from the month before. Homes are taking a little bit longer to sell. It's not that suddenly we've got, as you guys were just talking about, suddenly there's a bunch of new construction homes available for sale, or even that there's more homeowners are deciding to sell their home at a faster rate, say, there's greater turnover in the existing home. That's not true either. So the fact is that inventories are spending a little bit longer on the market. Overall pool of inventory is starting to increase, and price appreciation is really starting to soften. The other reason why we think that it's demand pulling back is because it was the most expensive places where now the slowdown is the most abrupt.
Skylar, do you still think that there's more correction? I asked this to Danielle earlier, but just in terms of what you think is going to be the new normal. Danielle gave us a range just right around 3% in terms of home price growth going forward. Where would you put your range?
Yeah, I mean, if we're talking of a comparison point to like the Case-Shiller index, I think 3% moving forward. I could see it continue to soften for the next few months. I don't think things will ever go negative. I think they'll turn around again. Maybe before the end of the year in terms of kind of getting back up to a more even kind of steady pace again. An important thing to think of when we consider housing market appreciation is our indices also weigh kind of the lower end as equally as the high end. When you do that kind of analysis, you get we're more in the 6% range, right? If you're thinking from the typical homeowner from the kind of mid-range price point. And that's an important thing to consider too, because it's the entry level price points. It's that lower end where we are continuing to see, that 6, 7, 8% appreciation points. It's really the higher end where it's very low. Now that said, low price points, high price points, both segments of the market, all segments of the market are slowing down. But in terms of kind of that normal, where I think we might end up by the end of the year, I think, we'll steady down. If we're talking the full housing stock, so starting from 6%, might go down to around, say, even 4 by the end of the year, never really going negative before we turn back around.
All right, Skylar and Danielle, thanks for joining me today.